Investing for Beginners, Lesson 6, Stock Taxes. Tax deductions on a loss is a benefit for investors. This lesson explains why selling a stock at a loss can be beneficial to your taxable income and your stock portfolio. What does it mean, tax deductions on a loss? It means when the price of your stock has decreased below your purchase price of the stock. Once selling the stock, the result would be a capital loss. How to offset capital gains. In other words, once selling a stock, you can deduct your loss of money from your yearly salary to lower your ordinary income so you pay less in federal and state taxes. You can deduct up to $3,000 in stock losses per year. Losses greater than $3,000 can be carried forward to future tax years. For example, you sell a stock for a $1,000 profit. You sell a stock at a loss of $500 because the stock has not increased as planned. When you go to file your taxes at the end of the year, your capital gain taxes would be reduced to $500 instead of $1,000. Again, stock profit of $1,000 minus stock loss of $500 equals $500 in capital gains. This would reduce your yearly ordinary income by $500 instead of increasing your income by $1,000. In summary, sell your stocks when you need the money or think it is time to take a profit. Sell stocks at a loss to offset capital gains. For another example, if you sell your stocks for a profit of $3,000 and you sell your stocks for a loss up to $3,000, you can offset your capital gains taxes to zero. This eliminates adding $3,000 in profit to your yearly ordinary income. This is also a very good way for you to realign your stock portfolio and save paying taxes to the federal and state governments. Thank you for participating in Stock Taxes video. Please continue to the next video.